Now, a couple more words about this whole Fed story. Here we go again. As I said, it's the most important one-man show on Broadway. It opens and then reopens 6 or 7 times a year. And the star of the show, Fed Chair Jay Powell, plays himself. The great thing about these Powell performances is they're kind of like Rorschach tests. You can read anything into them you want. Wall Street spends untold sums hiring analysts who try to interpret Mr. Powell. Investors are undoubtedly baffled by all this commentary. After today's performance, stocks went up 400 points or so somebody's happy out there. Now, are they happy because the Fed leaned against the wind and suggested no easier money? That Mr. Powell is going to hold the line with his 2% inflation target? Or that the Fed is not going to start slashing rates in order to juice the economy to re-elect Joe Biden? I don't know what the reason is. Others might say the Fed economic projections still show 3 interest rate cuts this year, even though these economic projections are nearly always wrong. I think the best thing Powell said was he's going to keep his 2% inflation target and not raise it to 3%. And in fact, the Fed's not there yet. Here's some price level indicators that we all should keep an eye on, including the Fed. The gold price since October up 20%. A key commodity index since November up 12%. Brent crude oil, $86. It's now up 19% since mid-December. Gasoline at the pump here in the USA, that's climbed 12% back to $3.52. In the Treasury market, most of the interest rates have gone up since the last Fed meeting in January. The actual inflation reports in the last 3 months have shown higher, not lower inflation trends. So I think Mr. Powell's right to stay cautious and not embark on some wild monetary pump priming and interest rate cutting eruption. By the way, interesting point. In a recent report, former Treasury Secretary Larry Summers has reconstructed the old CPI from the 70s and 80s that included personal borrowing costs like mortgage rates, auto loans, credit card rates. For some reason, these costs were removed from the Consumer Price Index at some point during the mid and late 1990s. I don't know why. But one reason why Joe Biden has a rock-bottom economic approval rating and consumer sentiment is so low is because car loans are running at 10% around, credit card loans upwards of 25%, and mortgage rates stubbornly above 7%. This is all causing great consumer unhappiness. Now, even though the experts took these personal interest rate costs from the inflation indexes, go on ahead, Summers reconstructed the CPI and came up with an 18% inflation peak back in April 2022. That's right, 18%. And a 7% inflation rate as recently as November 2023. So the story is even worse. The official CPI, as you know, 3.2% for the year ending in February. Now, even though since the beginning of Joe Biden's term, the price level has gone up over 18%, groceries 21%, energy up 30%. So with all this, Jay Powell is right to keep his pedal off the accelerator. But remember, folks, even on Broadway, there's no such thing as a one-act play. More to come.